What is the greater fool theory and how to avoid being the greater fool? The greater fool theory is a popular theory in the investing world that many people follow unknowingly. It is speculative in nature and should not be recommended to follow if investors want to avoid losses. In this video, we are going to discuss what the greater fool theory is and how it affects your investment decisions and how to avoid being the greater fool. Now let's look at what the greater fool theory actually is. The greater fool theory states that it is possible to make profits by purchasing assets which may be overpriced and selling them to another person or the bigger fool who is willing to pay an even higher price for the asset. The greater fool theory supports the principle that there's always a greater fool in the market who will be ready to pay a higher price based on some unjustified valuation for an already overvalued asset. The new estimates might be higher and irrational. Here, the investor purchases the asset without any regard to fundamental value or underlying principle, but only with irrational belief and expectations. They hope to sell it off at a higher price to another investor or the greater fool, who might also be hoping to do the same with someone else in the future. The price of the asset is determined by what the buyer is willing to pay, ignoring the true worth of the asset. Overall, here the investors are happy to pay too much for an asset just because they believe that they will find a greater fool who is willing to pay even more in the future. So where does this theory end? In the musical chairs game, X number of chairs are arranged in a circle and X plus 1 number of people are moving around the circle while the music is playing. When you run around the chairs, you might be thinking that there's enough chairs and all you need is one. However, everything changes when the music stops and you might not be able to find that single chair. Here, the irrational expectation that there are enough fools may lead you to lose the game. The greater fool ideology in the stock market is also very dangerous. Many times it starts fueling and causing the stock market bubble. Unfortunately, later this always ends up with a speculative bubble burst and eventually leading to rapid depreciation in the price due to the sell-off. Nonetheless, there will be someone who will be left stuck with the investment when the speculative bubble finally bursts. This is because when the end approaches, people begin to realize that the price attached to the investment is just unrealistically high and hence they might not be willing to pay a greater price for that asset. However, the ones that have already purchased the asset at a high price at the wrong time may be stuck with it. If you are following this strategy, there is no point in making sure that the greater fool isn't you. Now let's look at an example of how the greater fool theory ends with the dot-com bubble burst. The greater fool theory can help to explain how speculative bubbles are formed in different assets. During the dot-com bubble between 1995 and 2000, the prices of every IT company were highly inflated. The theory supported buying overvalued stocks in a hot market, that is the IT sector, with an expectation that a greater fool will come along and buy it from you at a high rate. At that time, instead of focusing on trying to find the true and intrinsic value of the company, people followed the herd mentality to invest in any and all IT companies. They were purchasing the stocks and simply trying to find a greater fool to whom they could sell the stock at a higher price than they themselves paid. However, the end of the dot-com bubble was not so happy. So many companies went bankrupt and shareholders lost their money. Many of the investors who planned to sell their hot IT stock later at a high price themselves turned out to be the greater fool. Herding in IPO subscriptions. Another example where investors turn out to be greater fools is while applying for hot IPOs. Here, instead of looking for value, the strategy is to enter a popular IPO company where everyone else is applying and sell its shares in the secondary market when the prices are high. However, the problem occurs when the prices of these newly public stocks don't go high after listing and investors are stuck with their overpriced stocks. So now let's take a look at how to avoid being the greater fool. Now that you've understood the concept, it is more important to avoid being the greater fool than to know the theory. It is quite simple to avoid being the greater fool. Here's how you can do it. Before making your investment in any asset, do your own study and research. Do not blindly follow the herd, paying a higher and higher price without any reason. Many people invest in hot stocks just because its price is going higher and increasing too fast, although they know that the price of the stock cannot be stable at that inflated price. Still, they are willing to enter the stock with the expectation of exiting soon and making some profits. If you want to avoid being the greater fool, avoid purchasing a stock just because its price is increasing. Control your greed to make money by irrationally buying overpriced stocks. just with an intuition that you can sell it at a greater price later. That's all for this video. I hope that this video was useful for you. Stay away from being the greater fool. Further, please comment below about what you think about this theory and subscribe to stay up to date. Have a great day and happy investing.